Okay, so in this video, we get to talk about the stock market. We hear a lot about the stock market, about stocks going up and down and markets crashing or markets doing well. But what is it? And here we try to understand the stock market in the context of financial markets that, again, would let borrowers and savers engage directly. Okay, so let's think about Facebook for a second. Let's try to make our symbol here. Let's say if Facebook, not bad. Let's say Facebook wants to expand its business. So Facebook wants to expand its business. It could draw down on its savings or prior profits to expand the business, or it could borrow by issuing stock to households or the public. So it can issue stock or shares to the public in return for money. Now, this sort of a setup is a little bit different from the bond market. In the bond market, you had a certificate that would say what the principal was, or what the amount borrowed was, what the interest was, and when that contract would mature. But in this case, the important thing is that Facebook, when it sells its stock to you, it gives you partial ownership to Facebook. So when you are a holder of Facebook stock or Facebook shares, you become a part owner of Facebook. And you get to claim profits that Facebook makes in the future. For example, when Facebook became a public company, so usually a company would go from being private to becoming public, where it starts issuing its shares or stocks to the public. This type of a process is called an initial public offering. So when Facebook went public back in 2012, I believe, the one stock or one share of Facebook was $37 the day it became public. And today, the same company, the one stock or one share of Facebook, is close to $200. Right? So what would have happened from, let's say, 2012 to 2020? If you bought that stock in 2012, today you could sell it and make a profit, a significant profit, and you could enjoy ownership of that company. You may have bought more stocks and your profit would go up. So that's something that you get to enjoy. So let's think about how stocks and bonds are different. So the differences between stocks and bonds. The first difference is that the owner of Facebook, I'm writing FB because that's the abbreviation it trades under, it's the ticker symbol of Facebook. The owner of Facebook stock or share is a part owner of Facebook, while the owner of a Facebook bond is a creditor of the corporation. The second difference is that if Facebook does well, which means that it becomes profitable in the future with whatever business it was going to invest in, then stockholders or shareholders enjoy the profits. Whereas bondholders only enjoy the fixed interest. So obviously in this case, we do want to entertain the idea that Facebook could also incur losses in the future. So if Facebook started at $37 per share in 2012 and maybe that became $20 a share today, right? If that happened, then obviously you have incurred a loss as a shareholder. And at this point, you have to decide whether you are going to sell it and just take the hit, or you're going to wait and see if Facebook can recover from whatever it is that is hurting Facebook. Okay. So the third difference between stocks and bonds is that if Facebook runs into financial difficulties, then bondholders are paid before stockholders are. And lastly, bonds and stocks have different type of risks associated with it. Typically, stocks are higher risk, higher and offer higher return. But bonds, they also come in different types of ratings. You could have AAA bonds that are the safest bonds to grade D bonds that are already in default. And there are many ratings that are available out there for people who are interested in investments. So after a corporation issues stock by selling shares to the public, these shares would trade among stockholders on organized stock exchanges. In these exchanges, the corporation itself receives no money when the stock changes hands. The most important stock exchanges in the US economy are the New York Stock Exchange. So we'll talk about stock exchanges. So these are organized markets where stocks are changing hands. So the New York Stock Exchange is one such stock exchange, and the other type is NASDAQ, which stands for the National Association of Securities Dealers Automated Quotations. Most of the world's countries have their own stock exchanges on which the shares of local companies trade. The prices which shares trade on stock exchanges are determined by the supply and demand for the stock in these companies. And because stock represents ownership in a corporation, the demand for a stock and therefore its price reflects people's perception of the corporation's future profitability. So if you're very, very optimistic about Facebook, for instance, or Facebook's future, then that would raise the demand for its stock and thereby bid up the price of the share of the stock. Conversely, if people think that the company is not doing well or has bad prospects in the future, then the price of that stock, price of the stock of the company would fall. So when we think about New York Stock Exchange, this is actually a physical floor, right? You can actually go to New York and actually look at where this is on Wall Street. But NASDAQ is totally electronic. There's also the American Stock Exchange. But this is only taking care of 10% of all the stocks that are traded within the US. So again, just to recap here, if you expect the company to do well, typically people would buy more of that company's stock. So demand for that company's stock would go up, and that would drive up prices or the stock price of that company, and vice versa. There are some stock indexes that are available to us to monitor the overall level of stock prices. If we really want to understand how are most of the companies performing, or the top 500 companies performing in the United States, we could look at a stock index, which is typically computed. So this looks at the overall level of stock prices for many different types of companies. It also is computed as an average of a group of stock prices. So either you can look at all stocks together, all the different stocks that are available to us, or you could look at particularly the tech sector stocks. So if you want to look at companies like Amazon, Tesla, you can look at companies like Apple, Microsoft. All of these are tech stocks. So you can look at what's going on with tech stock prices. You could think about that. or you could look at the healthcare industry. You could basically look at different sectors in the economy and make a sense of how that sector is performing. Or you could look at the entire stock market. One of the most famous stock indexes is the Dow Jones Industrial Average, which has been computed since 1896. So it's one of the oldest, and it really is just an average of the prices of the stocks of 30 major US companies. These would include Microsoft, Boeing, Apple, Walmart, and other companies, other big companies like that. The other type of stock index that's very famous is called the Standard and Poor's stock index. So this is called the S&P 500 index, which is based on the prices of the 500 major companies in the US. And because stock prices typically would reflect expected profitability, these stock indexes are watched a lot by economists about and other financial investment firms, by the Federal Reserve, to understand what is happening to our economic conditions.